This concept will completely change the way you view price action and will help you simplify your narrative building, which in turn allows you to achieve profitability. This is internal and external range liquidity. We will be going over their definitions, what they are, where you could find them, how to build a narrative with this concept, and how you could utilize them for your entries. Let's get started. External range liquidity are simply the swing points in a range. So in this example, the swing high and swing low marked out in this range is the external range liquidity. Internal range liquidity are the imbalances or fair value gaps in the range. Now, before we discuss the relationship between internal range liquidity and external range liquidity, it is highly advisable that you watch our daily bias video before this video. If you have watched the video, you will know that price has two functions. 1. Price will look to seek liquidity, and 2. It will rebalance any old inefficiencies. Now, you might be wondering, how is this related to internal and external range liquidity? Internal range liquidity are inefficiencies, right? And external range liquidity are swing highs and swing lows. So from that, you might have already been able to work out where I am going with this, and the relationship between the two. Price will always look to seek external range liquidity before seeking internal range liquidity, which is the same as the two functions in price. So, if we build on from the first example and put internal and external range liquidity on the same chart, this is what we end up with. Price takes out external range liquidity in the form of a swing high, and then it leaves behind an internal range liquidity in the form of an imbalance / fair value gap. Now, what can we expect price to do next after taking out external range liquidity? Seek internal range liquidity, right? And that is what we had here. After it rebalances internal range liquidity, a new external high gets created. The highest swing point of the newly created range now becomes your external range liquidity. Where can we expect price to go next after seeking internal range liquidity? External range liquidity. Simple. It's a lot of back and forth and an extremely simple concept to understand. When price takes out external, it goes for internal, then external, then internal. After price takes out this external range liquidity, a new range is created now. The external range low is now at the swing low, where price rebalanced the internal range liquidity, and external range high is at highest swing high. This is your new range. Again, price leaves behind a fair value gap, which is your internal range liquidity. And what could you expect price to do now? Seek internal range liquidity, then take out external range liquidity. Alright, now let's look at additional chart examples. So if you look here we had the previous external range high and the previous external range low. Let's mark this as buy side liquidity and sell side liquidity. But as you can see here, we were in a bearish trend and this was the previous external range high and external range low. However, when this range was created, so if I move this here, when this range was created, you would expect price to come back to rebalance any old internal range liquidity and then continue lower to take out external range liquidity in the form of this swing low to carry on your bearish trend. However, that didn't happen, and instead, price violated this external range high in a bearish trend. So what does this now become? This external range high now becomes your market structure break. And here we could anticipate a new range to form and bullish price action. So if I play price out, you can see that a new external range higher is now created. And now your new range is from here to here. If you look closely now, what does price leave behind? It leaves behind an imbalance, which becomes your internal range liquidity. And also another imbalance here, which again becomes your internal range liquidity. What could we anticipate now after price has taken out this external range high, right? Which became your market structure break. You would anticipate price to seek internal range liquidity now. So you could either come down to this or this internal range liquidity. Let's play it out and see what price does. So this internal range liquidity gets violated, and now we could anticipate this internal range liquidity to be our next target. So it taps into our internal range liquidity, and now we can anticipate price to seek for our external range liquidity if it was to continue in the bullish trend. And that's what it does. Now, a new range has been created. This is now your high. Where price rebalanced the internal range liquidity, that becomes your low now. And this is your new range. So, this is an internal range liquidity, a very large fair value gap left behind. Price comes into it. And now you could anticipate for price to seek external range liquidity after seeking internal range liquidity. And that was what we had here. Again, very simple. Now we will repeat the process again. A new external range high gets created. And the low that rebalanced the old internal range liquidity now becomes your external range liquidity low. And what gets left behind again? Internal range liquidity after it took out this previous external range high. So we mark this out as internal range liquidity. Playing price out. Price rebalances that old internal range liquidity, and now you can anticipate price to take out this buy side liquidity. And that was what we had here. Now do you see how simple but powerful this concept could be? Your objective is simply waiting for an external range liquidity to get taken. Once it gets taken, you will look to aim for an internal range liquidity before aiming for external range liquidity and repeating. External, internal, external, internal. That is simply what price does, because the two functions in price, like I said, seek liquidity and rebalance any old inefficiencies. Now let's look at another example. So here we have this external range high, which is your buy side liquidity, and here you have your external range low, which is your sell side liquidity. What would you expect price to do here? You would expect it to follow the bearish higher time frame direction, and then to come into one of these internal range liquidity. So here we have three. Let's make it more clear by making them different lengths. You would anticipate price to come back into one of these internal range liquidity before going lower and taking out this external range low to continue the higher time frame bearish direction. So let's see what price does. It displaces through the first internal range liquidity, and it also displaces through the second internal range liquidity. This is essentially your last internal range liquidity, and ideally you would want to see a move away from it to go for this sell side liquidity. So let's see what price does. Instead, a bullish order block is created which is supporting price, and you have further displacement higher, and price has a full body closure pass of this last internal range liquidity. This is where you can anticipate the external range high to get taken out instead of the external range low, because we had heavy displacement away in the opposing direction. And that is what happens there. So the lesson for this is you can't always expect your internal and external range liquidity to be perfect. A lot of times you will see price move in the opposite direction that you intend for it to do so. However, it will leave behind confluences showing that it will go in the opposing direction, such as disrespecting all of these fair value gaps with heavy displacement, which is your change in state of delivery. Now let's look at how you could build a narrative and how you could utilize them for your entries. So before we start, it's important to note that price is fractal, so this works on any time frame. So if you look here after price takes out this high, that becomes your market structure shift, and now we can anticipate for bullish price action. Price leaves behind a imbalance, and then it comes back and rebalances this imbalance. So if we drop down time frame, it will become more clear. So after this imbalance gets respected, along with your high time frame market structure shift, this is where you are anticipating bullish price action, and you can mark here your external and internal range liquidity. So if I use this on my external range liquidity is high, and this as my external range liquidity low. Here it leaves behind a fair value gap, which already gets rebalanced, but there's a possibility that price could come back and reclaim it. So if I remove this higher time frame imbalance and play price out, what can I expect? I could expect it to come down to this internal range liquidity, and then take out this buy side liquidity to continue your higher time frame bullish trend after you had your market structure shift. Let's see what price does. Right, so it reclaims this imbalance, and now I could go down into the lower time frame to confirm that this imbalance is getting respected, and I could look for entries. So here, if I go down to the lower time frame, I will look for the same thing. Again, I will look for a market structure shift with displacement. So here we had the market structure shift, right? And we had displacement. If we use the same concept of internal and external range liquidity, this is your external range liquidity on the lower time frame, and this is your external range liquidity high on the lower time frame. So now what does it leave behind? It leaves behind this imbalance, and we could anticipate it to come down to this imbalance, to rebalance, and then take out the external range liquidity is high, because on the higher time frame we are bullish and it's respecting this reclaimed imbalance. So it taps into that internal range liquidity. This is where your entry could be. with your stop loss below the external range low and your take profit at the higher time frame external range high. And let's see if it plays out. So it also takes out the external range high, which further confirms the bullish play. It takes you out for 3.7R. So if we recap that trade, on a monthly, you had your market structure shift, implying that a bullish trend is in play, further enforced by this respect of this imbalance. And then when you go down into the weekly, we use that respect of the imbalance as your external range low, and we use this swing high as your external range high. We had this internal range liquidity that we anticipated price to retrace back into after it took out the previous external range high, right? So when price retraced back into this internal range liquidity to reclaim this imbalance, we would look for this buy side liquidity to be our next drawn liquidity. So from there, we went down onto the daily time frame to look for the same concept again, right? Market structure shift on a lower time frame, and the same concept of external and internal range liquidity. This was your new external range liquidity, and this was your internal range liquidity, where you would anticipate price to come back into after taking out this market structure shift. And this was where your entry was, under that low, and targeting the higher time frame external range liquidity. And that is how you could utilize internal and external range liquidity to build a narrative and for your entries. So if we carry on here, still on the weekly time frame now, if we play price out, it implements a swing high. This is your swing high, and this is your swing low. This is now your range. And what would you anticipate price to do after it creates this range? You anticipate it to come back down into an internal range liquidity. Alright, so now let's play price out and see if it taps into the internal range liquidity. And it does. Now, same thing again. You go down to a lower time frame, see if it gives you a market structure shift. And it gives you that market structure shift, so it leaves behind this internal range liquidity. You could also use this internal range liquidity. Same concept as the reclaimed imbalance. Price could still come back into this internal range liquidity before continuing higher, but it's unlikely. So, to play it safe and ensure my entry gets filled, I would just place this order here for this unfulfilled internal range liquidity with my stop loss below here and my target above this higher time frame external range liquidity. Playing price out, I get tagged in. And then it hits the external range high on my take profit. It wasn't the cleanest trade, but the idea still holds. Weekly, internal range liquidity to external range liquidity. Daily, you had your confirmation and your entry targeting the weekly's external range high. Another entry you could have when you utilize this concept is this. So if I mark up my external range low and my external range high again, after price seeked this external range high, you would anticipate a retracement back into the internal range liquidity, right? Before continuing higher to continue the bullish trend, correct? Which I'm sure a lot of you are aware by now, external to internal to external to internal. So because we're anticipating this internal range liquidity to be our next target, here we could look for a short-term retracement play. So if you go down onto the daily, here you had your market structure shift, right? And this is where you would look to enter off. You could enter off of this order block, or take this fair value gap to enter off and utilize the internal to external range liquidity concept. However, because this is a short-term retracement play and the space for my take profit isn't that high, I would refine it to this order block for a better risk to reward ratio. So here, and then I would look to place my TP of the midpoint of this internal range liquidity on the higher time frame. Just about taps me in, and then it goes for my 2R target back into this higher time frame internal range liquidity. And now you could anticipate this internal range liquidity to stay respected and price to continue higher and take out this external range high to continue the higher time frame bullish direction. And that was what happened here. It's not as high probability as catching trades from the internal range liquidity to external range liquidity, but that doesn't mean it's still not profitable and you won't make money. You can still do it. External range liquidity to internal range liquidity trades are just not as high probability as internal to external range liquidity trades. And that concludes this lesson on internal and external range liquidity. Like I said, it is an extremely simple concept to understand. However, it will completely simplify the way you view price. So I hope this video was helpful. If you guys have any questions or suggestions for future video ideas, then please leave them below in the comments. As always, make sure you like and subscribe, and take care.